investing in the S&P 500, which includes the 500 largest companies in the US, has been a popular strategy in recent years. Many see it as a safe, reliable way to earn about 8% annually with minimal effort. But with the index now near all-time highs, are we setting up a debt of high expectations that could come due in the future? In this video, we'll dive into expectations debt, a concept popularized by Housel, the author of The Psychology of Money. So let's dive in! So what exactly is expectations debt? It's essentially the gap between what people expect and what reality can deliver. It's like a debt that builds up when our hopes or assumptions grow too high, setting us up for disappointment when things don't turn out as expected. A great way to understand it is by comparing the S&P 500 with the Nikkei, Japan's stock market index, which is similar to the S&P 500. The Nikkei has recently closed at its highest level since 1990. Now, that sounds like a win, right? But consider this. Returns in the Japanese stock market over the past 34 years have been terrible. Yet, returns from 1965 to 1990 were amazing. The Nikkei and the S&P 500 have actually had similar returns over 57 years. But the Nikkei earned almost all of those returns during a huge 25-year surge. After that, it stagnated. The S&P 500, by comparison, has been much steadier over time. What happened with the Nikkei is a classic example of expectations debt. From 1965 to 1990, the Japanese stock market grew so quickly that 50 years worth of returns were packed into just 25 years. Investors expected that growth will keep going forever, but those expectations were like a debt that the Japanese stock market has been paying back over 3 decades. This debt was not on any balance sheet and no one got a bill from it. But it was real, holding down the market, draining wealth, and taking over 30 years to pay off. So how does this apply to the S&P 500 today? Right now, the S&P 500 is trading near historically high valuations. While it has delivered an average annual return of around 8% over the last 100 years, the S&P 500 has almost doubled that rate over the past 5 to 10 years. With AI, stock prices have surged on high expectations, and since January 2024 itself, the S&P 500 has seen a 25% return. If you have started investing in the S&P 500 or plan to, you might be wondering how to avoid the risk of paying the expectations debt if the index stagnates in the coming years. The best answer to this question is to have a very long-term investing horizon for the 3 following reasons. Reason number 1, market cycles tend to average out. Over decades, the S&P 500 goes through many ups and downs, but a very long-term investor can ride out those cycles as the market's general upward trend smooths out short-term declines. 2, economic growth drives long-term returns. The S&P 500 represents the largest US companies, which tend to grow with the economy over time, giving long-term investors a solid chance of positive returns even after a correction. 3, time reduces the impact of volatility. The longer you hold, the less impact your starting point has, as steady growth gradually smooths out the effect of entering at a high price. Remember, you cannot succeed in investing if you don't survive the tough times. Don't be fooled by averages. Saying the S&P 500 has delivered on average an 8% annual return over the last 100 years doesn't tell the whole story. One of my favorite adages is don't forget the man who was 2 meters tall and drowned crossing a river that was only 1 meter deep on average. Surviving on average is not enough. You need to survive every day, especially during the bad days. If you hold onto your investment in the S&P 500 long enough, you'll be able to weather the down cycles when the market dips. This is it for today, guys. If you got value from this video, feel free to drop a like. And if you want to receive more content like this, feel free to subscribe. Thank you all, and peace out!